10-year note yields move lower midweek. Early on in the session, we saw yields moving all the way down to 408, lowest since near March 11th, after the fact that we had some rising geopolitical risks, some mediocre economic data, and then came the Fed. The Fed was really the highlight of today, July FOMC. The Fed did not cut rates, nor did they indicate when they might start cutting rates. However, some of the language they used, things like we're not considering 50 basis point cuts, we want to keep everything data dependent. The market didn't seem to care. The market continues to fully price in one 25 basis point rate cut at September, and now seeing 18% odds of a 50 basis point rate cut at September, along with cuts at November and December to follow. So clearly the market wasn't listening to what the Fed had to say, but was more or less creating its own path. We saw 10-year note yields doing the same thing, seeing yields continue to move lower. Yes, those geopolitical risks remain elevated, and yes, the economic data has been mixed. But ultimately, we saw yields trade all the way down to 405. That's just above the 6-month low to close the day down 8 basis points from yesterday's settle. Now, what does this mean for volatility? Well, check out that CVOL index over at cmegroup.com. You'll see the volatility was steady early in the morning, but then started to drift lower with yields. And then ultimately, after the Fed, we saw things really moving lower as that post-event hangover sort of kicked in after the event, after all the hype. And the market takes a sigh of relief. We see volatility moving lower with yields, and that's typically what we see. We saw that today. Again, volatility moving lower with yields. Lastly, let's talk about what we have tomorrow. Tomorrow's Thursday, which means we get our in-the-moment look at the job market via the claims number. We also get ISM, and then we talk about that post-FOMC trade, that sort of the day after. How will the market react after having a little time to digest not only what the Fed said, but how other market variables reacted to today's FOMC. So midweek yields make another move lower after a tepid FOMC announcement with no rate cut, no real clear guidance on when they are going to start cutting rates ahead of tomorrow's claims and ISM and that post-FOMC trade.